Hello, everyone. Thank you so much for joining the webinar today. Uh, Today's topic is on financial investments and updated tax slabs. So this is going to be a very helpful session for all the employees. We are always looking for someone who can guide us with the financial investments, and of course, we try to Google in regards with the updated tax slabs. So I think we have an expert here who can help us with the financial investments and the updated tax slabs as well. He is going to inform us how to make decisions, in regards to in regards how you can maximize returns, reduce tax liability, and ensure long-term financial stability. So it's going to help in strategic planning, aligning your goals and with smart savings and staying compliant with the changing tax laws. So we have with us Mr. Pratik S. Kothari. He is going to guide us ahead. So Pratik, thank you so much for joining the call. Now I'm handing over this session to you.
Sure. Thank you so much, Kuva. And I would like to thank Manjunath and Standard Chartered for inviting me for giving this session. I'm a chartered accountant, practicing chartered accountant, and I help people file their taxes, individual, corporate, or GST compliances, etc. And I'll share the screen. I've tried to keep it as simple as possible, but the focus is on the taxation which the employees would have to face or decide. And when we see the budget, we've seen there has been a lot of changes, especially with the new regime. And it's important to know how it's going to impact and actually benefit all of you all. So first we'll start with the understanding of the total and taxable income, because in general also employees have two things which they look at. One is the CTC, one is the net in hand salary. Similarly, in the income taxation wise also you have either it's a total income or a taxable income. Then we'll summarize what are the tax saving options and the deductions which the employees can have. We'll dwell deep into the new and old tax regime with a couple of examples. And although this is not directly related, but capital gains tax planning is also really important, because most of you all must be investing in shares, mutual funds, etc., long term, short term, and you may buy or sell your properties. So it's an important understanding to have. And then in the end, we can have FAQs around common mistakes to avoid in tax planning. And then we'll have the questions. So we can have all the questions at the end. So you can note them down as you have them and we can discuss. So, a couple of questions which you may have or you should have and have clarity. So, first is, what is tax planning? The process that legally reduces the tax liability through deductions, exemption, and rebates. So, when I mention legally, I want to be very clear, because government has given you options where you can plan your taxes, reduce them. But generally, when the Form 16 is generated, we get a lot of requests saying that how can we maximize the refunds? We always suggest the best options to do that. But if you try and reduce your tax liabilities through means and options which are available in the system, but you're not actually eligible for them, then recently the government has started sending a lot of notices. Hence, I want to highlight that you should plan and reduce your taxes with whatever legal means available. But if you try to overdo it, it can really create issues for you guys. And why is it important? So that it will minimize your tax burdens. And obviously, the tax which you save is like a savings for you, which you can invest elsewhere for your future, or just your spending capacity increases. Who needs tax planning? Everyone: salaried, professional, business owners, senior citizens, non-resident Indians. If you may have not been in India and now you're working in India, or if you plan to shift outside India in a couple of years, still tax planning is necessary for all of you. And what's the best timing? Earlier the better. So because we are in April, financial year 25-26 has just started. It's best that you understand what your taxes are, what is the planning you can do, or which schemes you should select, so that you don't have to unnecessarily panic at last moment in Feb and March suddenly when your excess TDS is deducted and in-hand salary is really low. And if you have other sources of income through investments, assets, etc., then you need to plan them because your payroll or your salary only deducts TDS for your salary income. Others you need to pay them when you file your return. So you may end up paying extra tax interest on that. So in general, currently you are an employee of your organization, so you will have your salaried income. But there are total five heads of income. First is salary. Second is rental income. So you can have your residential or commercial premises which you must have leased out. So that becomes the second head of income, which is rental income. Third is income from business, including if you are trading in shares for futures and options, that is a business. So your income under that should be shown as business income. Fourth is capital gains. So your shares, mutual funds, buying and selling of golds or even properties come under that. And last one is other sources. So you'll have your interest on FDs, dividends, interest on PPM, etc. So all these five heads of income combined gets added in your total income, and that's what we call your taxable income, which gets filed in our ITR. Why knowing this is important is because many times what happens, people feel my total salary is below taxable limit. I don't need to file my income tax return. But that's not right. You may have some investments which are generating passive income for you all, which also gets added. Or many times when you try to self-file your return, as per your salary, your tax is deducted. You should not, you feel you should not have any additional tax. But then you see an FD, and if you're in a 30% tax slab, the TDS deducted is 10%, and you'll see a differential 20% liability generated. That is because your income is getting clubbed together, and that's at the highest slab. Now, the second point is important to know your residential status because there might be some employees who must have just come to India or maybe outside India for a couple of years. So it's important to understand your residential status. I will not go deep into it, but I've tried to accumulate some points which are important because after the session, when I share these PPTs, you can dwell deep into the topics that may find more useful to you. Deductions and exemptions and rebates. So generally there are three categories with which you can save taxes. You have deductions, exemptions, and rebate. Deductions are basically your 80C deductions, housing loan interest and your LIC, PPF, term insurance, mediclaims, etc. Exemptions are part of your payroll. It can be exemption for HRA, which is house rent allowance, LTA, leave travel allowance, and certain medical exemptions, etc. Rebates is something which the government offers. So, example, currently there's a rebate of 75,000 for a salary which is below 12 lakh rupees. So, that is a rebate which government is offering. And then out of the heads of income, there may be some, most of them are taxable, but few are exempt. So, example, if you get a gift from your wedding, it's exempt. If you get any PPF interest, that's exempt. If you're a partner in some partnership firm, that's exempt, and so on. So it's important to know what's my taxable income and what is not. Purva, you can just stop me if you feel there's some need to stop, else I'll keep on continuing because I wouldn't know.
Sure, Pratik.
Thanks. So now predominantly there are two schemes which exist. Default scheme is new. At high level, if I want to summarize, new scheme, it has beneficial tax slabs, but it does not have any options for deductions or any other claims. Old scheme is the same which has been considered or happening since so many years, where the tax slabs are comparatively higher, but you can claim deductions under 80C or all these type of allowances. So for allowances, you can have HRA, LTA, conveyance allowance, meal allowance, and many more. In the next slides, I have added a list of detailed allowances and deductions, which you guys can refer to, which is similar to this. These are all the deductions with all the deductions who can claim and the conditions and including these. But that I've just kept it for your reference. And deductions, you can have 80C, 80CCD, NPS, medicals, etc., and many more. So hypothetically, if someone is investing and utilizing all the deductions, so they can claim exemptions or deductions close to 6.36 lakhs because we have 1.5 lakhs limit under 80C, which has your tax saving mutual funds, NPS, life insurance, PPF, Sukanya, etc. You have additional NPS option of 150,000 rupees under the NPS tier 1. and you have additional 1.5 lakh under 80 CCD2. Health insurance 50 lakhs. Plus, if you have your parents, senior citizen, you can get additional benefit. You have principal interest payment on loan of 2 lakh rupees, which gets additional deduction. Now you'll see a small asterisk because either you can have an interest on self-occupied house or you can have a house rent allowance. Now house rent allowance can be much more than 2 lakh, but just to compare apple to apple, I've capped it at 2 lakh currently. Hence the asterisk. You can claim any one of it. You cannot say I have a self-occupied house property and also I'm staying on rent and I want to claim HRA. People do that, but then they face notices. Hence, I've highlighted it. And you have your food allowances, etc. So around 6.36 lakhs is where if you have these many deductions, that's where you can utilize them. This also means you're actually spending this much amount or investing this much amount from your regular payments. So to be able to achieve these, you actually have to spend these amounts, provide your HR, the declarations, etc. These are the list of deductions which you guys can review in detail once the session is over. Now, why there's a difference between new and old regime? The difference is because of the tax slab. So in old regime, anything my income up to 2.5 lakh is taxed at 0. 2.5 to 5 lakh is taxed at 5%. 5 to 10 is at 20, and anything above 10 lakh is flat 30%. Whereas in new regime, there's a much more spread and the breakup around taxes. So the differential tax is much better. So up to 4 lakh nil, 4 to 8 is 5%, 8 to 12 is 10%, 12 lakh to 16 is 15, 16 to 20 is 20%, 20 to 24 is 25, and about 24 lakh rupees is 30%. So even if you consider the difference between the 30% slab of 10 lakh and 24 lakh, 14 lakhs multiplied by 30 percent, which is close to 5.2 lakh. That is the difference we look at in terms of the differential benefit you get in the new regime. Now, obviously, these are just slabs. Here I've tried to highlight, if you focus, I've categorized 4 different income variants: 13 lakh, 20 lakh, 26 lakhs, and 50 lakh. If you have tax in new regime, a person earning 13 lakh rupees has to pay 25 lakhs, versus if in old regime, he would have to pay 1.87 lakh rupees. And to able to match his new tax regime, if he takes old regime, he needs to have investments and deductions worth 6.87 lakhs. Then he will be at par with the new regime. Similar to 20 lakhs, he would have to invest and have deductions worth 7 lakh rupees to be able to be at par of tax of 1.85 under new regime, and so on. So when you see these numbers, immediately you can conclude at high level, either you need to invest and have these many deductions in place to be able to match the new regime, or else new scheme is always better. Secondly, when you try to save tax by investing in tax saving options, you also lock your money. Of course, investing is good because ultimately that's saving. But if you put in PPF, it's 15 lakhs lock-in. If you put in ELSS tax saver mutual fund, it's a 3 lakh lock-in. If you take your insurances, that's a amount again blocked. Whereas you can use that same money to put it directly in equity, mutual funds, etc. So where to invest is your call. But if you try to go in tax saving options, it is going to create a time cap on your investments where your money is basically blocked for a while. But you can have these references to decide, because currently, because the new financial era started, you either need to declare to your HR portal whether you want to go in new or old. And if you're going in old, you need to know what kind of deductions you are eligible for. So this will help you to decide. In new versus old, what you should compare is what's your income and what's your slab rate. The easiest way is you can go to the income tax website, put in your income, and you can understand your income tax, which is eligible till new or old. Your HR portal also must be showing you the same things. All the allowances and deductions are allowed only in the old regime. In new regime, you have only standard deductions of 75,000 that's eligible. NPS contribution is eligible, and eligible businesses which are allowed under 80 JJA. So these 3 are only available in new. The rest, it is all available in the old ones. And in new regime, any income which is up to 12.75 lakh in total in salary is not taxable because you get a rebate under that. 12.75 lakh in total in salary is not taxable because you get a rebate under that. 12.75 lakh in total in salary is not taxable because you get a rebate under that. 12.75 lakh in total in salary is not taxable because you get a rebate under that. 12.75 lakh in total in salary is not taxable because you get a rebate under that. Now, considering new regime and the rebate. So when you see there is no tax till 4 lakh rupees, but then why do people say there is no tax till 12.75? The difference is where the rebate is offered. So if my income is 10 lakh rupees, my tax as per the slabs is 32,500. But government gives me a complete rebate. They waive off my tax. So my tax is actually calculated, but at the same time, it gets zero, and hence my total taxable income becomes zero. If my income is 12 lakh rupees, my tax is 52,500, but I have a rebate up to 75,000. So whatever my tax up to 75,000, subject to my total income is 12.75 lakh, my tax becomes zero. The moment I cross 12.75 lakh as my threshold limit, which is 12 lakh plus 75 is my standard deduction, I'm at 13 lakhs. My tax is 66,300. Now I'm beyond the rebate limit. So rebate up to 41,000 will be deducted and 25,000 will be my income tax which I have to pay. So you are still getting a rebate, but there's a differential liability you have to pay. Now my income is 30 lakh. I'm not eligible for any rebate. My tax is 4.75 lakh. I have to pay the entire tax amount, similar to 50 lakh rupees. So the conclusion of this is if your total income is below 12.75 lakh rupees, you have to not pay any tax. And if that's above, then till a specified threshold, you will still get a rebate. After that, your rebate goes away. Then you have to pay your tax in full. Before we move to capital gains, because it's a separate topic altogether, we can have a 10-15 minute session for questions around these because then we can have the questions at the end for capital gains. Is that fine, Purva?
Yes,
Hi,
Pratik,
Pratik
that's fine.
Kothari here. I suggest we'll continue with the session and at
Okay,
the end we'll have the Q&As. So
sure.
it
We
should
can
not
do that.
happen that we are losing on some information if there is like there we have a time constraint for the say session to get completed. So it is
Sure.
15 minutes. So I want everything should be covered. If they have any questions, they can also write back to your email ID that you will share with
Got
them.
it.
Yeah.
Got it. Moving to capital gains, as I discussed earlier, this is important when you are dealing in shares or mutual funds. You must be using your Demat account, Zerodha, Grow, whatever. And there are two types. Either you buy and sell your shares, mutual funds, etc., or you just hold them. Whenever you sell and there's a variation in your buy price and sell price, there's a gain that's called as capital gains. Now, capital gains is not just restricted to shares and mutual funds. That's a common asset. It is also about your property. So you buy a land, you buy a house, you buy an office, anything you buy, which is a capital asset in nature. And when you go to sell them, you have to pay capital gains. Now, capital gains are majorly categorized in two parts. One is long term and short term. And why these two categorization are important is when you talk about long term, let's say you buy shares worth 10 lakh rupees right now and you hold them for 2 years and you sell them at 20 lakhs. Because you hold them for more than 12 months, they categorize as long term. You're going to be paying tax on the differential gain, which is 10 lakh rupees at 12.5%. If the same gain was within 12 months, you would have to pay the same gain 10 lakhs, you would have to pay tax at 20%, which is higher. So if your holding period is more and your asset classifies as long term, you have to pay tax at 12.5% versus 20%. Now, this was for shares. Instead of that, if it is a property, let's say you buy a flat today and you sell it after 3 years, because for capital gains for real estate is 24 months to categorize as long term. So let's say you buy an residential flat for 1 crore today and you sell it for 1.5 crore after 3 years. The gain of 50 lakhs is going to be taxed at 12.5%. Whereas if it is short term, it is before 24 months, you will have to pay tax at 30%. So differential tax is almost 7.5%, which is close to twice of what you would pay in the long term. That's why folding is important. So let's say you buy something, you decide to sell. If you know in a couple of months it is going to get classified as a long-term asset, it's always better to wait. Or you can execute the deal in terms of the communications, etc. Paperwork should be executed after you classify it as long-term because your tax slab is lower. Second important thing, once it is categorized as long-term, you have options to not pay any tax by claiming exemption. So government says that if you are selling any long-term asset, be it your shares, mutual funds, house or office or land, if you're utilizing that money to buy a house for yourself, then if the amount reinvested is within the time frame, you don't have to pay taxes. So this is eligible only when your asset is long term. So again, planning it in the right way and selling a long term asset, you have the option of not paying any taxes. So let's say take a bigger example, a same one which I had given earlier. 1 crore you bought that flat for, in 3 years you sold it for 1.5 crore. At 50 lakh rupees gain, you are technically supposed to pay 7.5 lakh rupees income tax on that. But you sold that house and you buy another house. Now that 7.5 lakh tax becomes zero because you reinvested it. So similarly, government gives you a lot of options, either buy a house or buy capital gain bonds. If you want to buy a house but you've not identified anything, you can put that money in the capital gains account and then buy that house. So that's the key of that. And what happens now because of the AIS, TIS, and 26 AS, government has the entire data. I see n number of examples where an employee shares a Form 16 with me and says that this is my Form 16, this is the only income I have. Then we go to file the return, and then we see on the AIS portal there are transactions for shares and mutual fund. It may happen that you're not aware, your father must have or family must have opened a demat account and they are operating it, or for a wife, she is not investing, but the husband is operating the account. But it's important because now everything is reported. All these agencies have to report the transactions. So it's important for you to know first what your assets, investments, and incomes are. And secondly, you can always go to your income tax portal and review your 26 CS or AIS PIS. AIS is Annual Information System, which is available on your portal. So even at end of the month or let's say first week of May, you should go log into your income tax portal, download your AIS, TS, and 26 AS for 24-25 financial year, because that will make you realize what are the details you need to give to your CA for tax filings. If you are filing it yourself, then you would know what are the income heads which you would have to look into. So this was about capital gains. Not going into more details, but it's important for you to know them because most of us are some or the other way gaining profits or losses through these. And if you're having losses, it's even more important to declare because you have the options to carry forward your losses. So let's say this year the market is down, I end up booking 3 lakh rupees loss in my portfolio. But next year I end up having 7 lakh rupees gain. If I file the return on time and if I carry forward my 3 lakh loss properly, I can offset this loss next year in the gains and pay less tax because I have that opportunity to carry forward my losses for 8 years. But identifying them and reporting them is properly is important. Common mistakes to avoid in tax planning. Last minute investment. So example, you are in March and suddenly you realize my income tax declarations are not complete. I'll go and buy some tax saving mutual fund. I'll just put 50,000 in my PPF, etc. Last minute trust is poor, results in poor choice of decision. Secondly, not comparing new versus old. So today, let's say you decide you go into the old scheme and you declare all your declarations. While filing your returns, you realize the new scheme is better. Of course, you can go into new scheme then, but that's resulted in excess TDS and your money blocked with the government for almost 18 months, which you have to claim refund for. So understanding which scheme is better is more important and accordingly declaring, because once you declare, your company is going to deduct your taxes accordingly. Documents and proof if not maintained properly. Your tax returns are always self statements. Government does not check anything. You put in the number, they'll accept it. But it's important to have a record of these details, documents, payrolls, Form 16s, or even the investment related documents, because whenever there's a notice, we can always attach them and close that inquiries. If we don't have the right documents 3 years later, it's difficult to retrieve them. You may have changed your email ID, you don't have the documents, etc., but it becomes difficult. Another one is non-payment of advance tax. So, like I mentioned, your company will deduct your taxes on your salary. But if you have additional incomes which are going to be accumulated to your income and you don't pay any advance tax on that, you end up paying interest. So, let's say your additional tax liability is 1 lakh rupees. You end up paying close to 15 to 18,000 rupees interest, which could have been avoided by just paying the taxes quarterly. So, that 1 lakh rupees divided every quarter, you would have paid 25,000 every quarter and save that interest. And most importantly, like I mentioned, you need to check your TDS, TCS. You need to see whether your banks who's deducting your TDS on the car you on the FDs, or let's say you bought a car, you see TCS being charged on a car or a foreign tour you did. Are these amounts getting added to my income tax portal? It's really important because that's the money you've paid and you should get it reflected on the income tax portal, so that becomes part of your total tax rate. Thank you. And we can have the question answers. And in case the time runs short, you can always write your queries on this email, and me or my team will happily revert back to you.
Hi Pratik, I have a question. So if
Sure.
like I want to like go with the news regime, and when I will be file my RTR, so can I switch my for a old regime to fill
Yes,
RTR
you.
in the
Yes.
sorry? Okay.
Yes, you can shift to the regime, subject to
Okay.
your filing your tax return in time. If you file your return before 31st of July, you have the option to choose your regime. If you miss the deadline, if you file it late, then you only have the option to file with the default regime, which is new.
Okay. Okay. Thank you. Thank you very much.
Anyone else has any questions? You can just unmute yourself and directly ask the question to Pratik.
If there's any specific slide you want me to go back to and have a discussion around that, we can do that as well.
Pratik, after selling some property, for how long we can keep the money in capital gain account
Yeah. So
before doing the next investment?
right. So first we need to understand the due date for putting the money in capital gains account. So let's say 24-25 financial year got over. You sold a property in December or March, but within last financial year, you either need to buy a property 1 year prior or 2 years later. So let's say till July, which is your tax filing due date, you have not identified any property. You have to put the money before filing the tax return in the capital gains account. You can maintain that capital gain account for 2 years because the limit to buy a new property is 2 years from the date on which you sold the property. So if you sold your property on 31st December 2024, you need to put the money in your capital gains account before 31st July 25 because you've not identified any property. And you need to find a new property and buy it before 31st December 26. If throughout these timelines you're not able to find the property or buy a property, you will have to pay the taxes.
Okay, what percent it is? 30%?
No, if it's a it's a long-term asset, right? So it was going to be 12.5% because you can only get investment benefit if it is a long term. If it is short term, then you cannot even put the money in the capital gains account. It is directly taxed at 30%.
Okay, thank you. Thanks.
Pratik, in continuation to this question, can we keep that amount locked for 5 years and then we are not required to pay any taxes on it?
No, so locking is 3 years. So when you put the money in reinvestment in a new property, you need to hold that property for 3 years. After 3 years, you can sell the property. The 5 years lock-in is for capital gain bonds. If you invest in capital gain bonds, you need to hold them for 5 years.
Okay.
So I can see a message in the chat. What are the deductions available under new tax regime? Like I mentioned, only standard deduction, NPS additionally. These are the two deductions available under new tax scheme. You cannot get HRA or all other deductions which were there for old scheme.
Yeah, I think we have less than 1 minute, but thank you, Pratik. It was really a wonderful and informative session. And thanks for your time and presenting this to us. This will
Thank you
really
so
help
much.
all of us. Yeah.
Sure. You can note down this email ID. If anything more questions, you guys can do that. And I'll share this PPT with the HR team. So if they want, they can forward it to you guys for your reference.
Sure. Thank you, Pratik.
Thank you.